Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
I have some news that you can use, and that is this, that adversity is a part of our life. If we make all the best choices in life, we can avoid unnecessary adversity. But even if we do, adversity, it will find us all. COVID-19, coronavirus. If you want to learn how to overcome adversity, which all of the best do, they learn how to overcome it. Get on our bus, get on the Supreme Lending bus, and we'll take you to destination, and it will be the best destination so that you can become your personal professional best. Let's get on with today's program, shall we? Our vision, that is at Supreme, of course it is, to become the best mortgage banking company in America. Our mission, how we're going to get there, is to live our lives selflessly and to serve others before ourselves. And finally, our inspiration, and you know this because we're partners, and that is to deliver the industry's best customer experience so you and your customers can become raving fans. You can get on our bus. That is the energy bus, the Supreme Lending energy bus. Here we go. We're all about three things in our exchange with you. We're about inspiration, we're about education, and we're about service. So let's talk about those things today, right? First, to inspire you, to remind you that relationships are the most important thing we do in life because they are. You need to be for everyone. I'm for everyone. I'm not for everything, and neither are you, but I'm still for everyone. Remind yourself of that today, and especially as we're coming into an election season, we need to be for everyone. We're not going to be for everything, but be for everyone. All right, here we go. Let's talk about this event. We started the year with a 3.5% unemployment rate, and then that thing happened. That's right, COVID. Coronavirus, it showed up and it changed everything. We also started the year with 3.5% interest rates. So the unemployment rate, 3.5%, interest rates, 3.5%, both of them all-time lows. We were set up to have a really good year in housing. Sales were going to go up 2.7%. That's right. Our good friend Doug Duncan, Education, he joined us early in the year and he told us that we were going to go up about 2.7%. And Doug is the most fantastic forecaster on the planet in the housing finance business. And so we rely on him, and so do you, for education so we can plan our businesses. Well, I asked him at the time, Doug, you think this COVID thing, it was in February, could be a black swan? A black swan, by the way, is an event that you don't see coming that dramatically impacts Doug's forecast. We didn't know at the time, but now we do, right? That COVID was, in fact, a black swan. It was going to change everything, and it did change everything for the first time in our country's history. We actually put the U.S. economy, the patient, into a coma. We did that to flatten the curve. Remember flatten the curve? It was to slow down the spread of the virus. Why? Because we didn't have a vaccine, still don't. And we didn't know how to treat it, and we were very concerned because of the nature and the danger of this particular virus. And so we thought if we flattened it, we would not overwhelm our hospital systems and we'd give our medical teams time to come up with better treatment and therapies and to work frantically, warp speed to get a vaccine. All right, so that's what we did. We shut the economy down. And what happened? What were the consequences of shutting it down? Amazing. 55 million people so far since we shut it down in March. 55 million people have made an unemployment claim. 55 million. Fortunately, the number's finally going down. We'll get to that in a minute. Unemployment rate went from an all-time low, 3.5%, to an all-time high since the Great Depression, 14.1%. It's back down to 10.3%. But can you imagine? 3.5% in a 3-month period. It went up to 14%, an all-time high, all-time low, all-time high. Unbelievable. Interest rates, they actually went down. Why? Because the Federal Reserve coached them down so that we could help the patient. The GDP, it went down 32.9% in the second quarter. I just said that. I'm going to say it again, 32.9%. The idea of 32.9%, if someone would have told me that that happened and I didn't know anything else, I would have told you a nuclear bomb went off, and in fact, one did. It just happened to be called coronavirus. Housing sales for the quarter, second quarter, that period of time, they went down 18%. We were supposed to be up 2.7%. That took that possibility away for the year, but we're getting back to where we were, which is now we're pretty hot in housing. And finally, our debt, we started the year around 23 trillion. We're up to 26 trillion, on our way to probably 28 or 30 by the end of the year. Why the consequences of reduced revenues have really hurt our debt and stimulus, et cetera, et cetera, et cetera. All the checks that we've sent out, which, by the way, to try to keep the patient alive while it was in a coma. All right, let's talk about the restart, right? So that's what happened. Those were the consequences of putting the patient into a coma. Then we decided to restart the economy, and let's see what happens, right? So all the economists then that are out there, for the first time, seeing that we actually put this patient into a coma, said, well, let's talk about what happens when we try to bring the patient back. Well, we could get a V. That's what everybody hopes for, victory. All right, right down, right back up. Then the U, we stay a little longer, and then we come back. The W, we go down, which we did. We get back up, and then unfortunately Corona hits again, and we have to go back down again before we come back up. Then there's the Nike swoosh, greatest marketing company. One of them anyway. We could argue about that. One of them. And that is a longer recovery, right? But we do recover. L, not good. Losing, not good, okay? Economy goes down, and it never comes back. And then this radical sign, I'm not even quite sure how to think about that, but it's possible. Anyway, what to watch? We told you from the very beginning that we thought that the patient getting healthy, there were going to be three things that were going to need to happen. The patient being the U.S. economy. First, on monetary policy, the Federal Reserve was going to have to come in and really make sure there was plenty of gas in the gas tank to get this patient to actually move afterwards. And guess what they did? They dropped rates to zero. That's right. They went from 1.5 to 0 immediately. Then they started buying securities in the marketplace. They bought everything to really make sure that blood flow continued while the coma was taking place. So that is monetary policy. They did a great job. Let's go to Washington, all right? They actually were doing a really good job. They sent out stimulus cash to every single person, basically, under $100,000 earnings in the U.S. economy. They subsidized unemployment checks, right? So they created an additional $600 a week for those that were filing unemployment. They went through substantial amount of stimulus, PPP, Payroll Protection Plan. They did a number of different programs. And then when they had to show up again recently, they got back into, we're not for you and we don't agree, and so we're not for each other. Not a good idea, okay? We need them to be for us, okay? For us, even if they don't agree on everything, be for us and do something. We need to get that box checked. So we're still in that blame game event right now, and we need additional stimulus because we're still not back as an economy right now. So the president took some action on his own, but we need more comprehensive action, more comprehensive stimulus. That's what almost every economist believes is necessary to continue the comeback that is underway as we speak. All right, let's talk about what's happening with the final issue, which is with coronavirus itself. All the way to the left, these are new tests. We've actually had fewer tests recently. We have some ideas about why that is, not because there's a conspiracy, but because people initially, when testing got to be made available, they wanted to go get tested. Well, now people are only getting tested, we believe, if they really feel like they need to. So testing will probably come down now that we know we have access to it. New cases, we're starting to see them finally drop. That's a good sign. It's a lead measure, right? And the lag will be ultimately hospitalizations going down. Good news, we're starting to see that happen. And deaths, they have not yet started to come down from the most recent numbers, about 1,000 a day. But we are looking forward to the lead measures, cases, hospitalizations, being followed by the lag, which is ultimately deaths coming down. So we are getting better. We are much better today at treating this particular virus. The therapies and vaccines, people now understand in the medical system the best methods to use based on where people are at any given time. Early, mid, late sickness, they have treatments now for each one of them, and so they're getting to be more effective. Death rates have come down and will continue to come down from the very beginning. And vaccine advances, of course, we're hearing that there's some around the world that we probably don't want to try. But our folks here in America, all of the companies, and by the way, in the rest of the world, people are making the effort as well. But we've got an awful lot that are in the process, manufacturing process right now. We're going to get some winners, I believe, before the year is out. And that would be really good news because that will give a confidence that will allay many fears and get people back out doing what we need them to do. Go to restaurants, go to concerts, go to football games, college football games. Anyway, we are making progress on the medical front. All right, let's move on, okay? Let's check in on what the patient actually looks like today. How about that? Let's look at unemployment. Let's look at retail sales. Let's look at the stock market and then look at something that we are very interested in, right? Let's look at housing. Unemployment, first of all. Last week, weekly unemployment claims that come out every Thursday, the weekly claims were under 1 million for the first time since March when we first put the patient into a coma. That's really good news. Really good news. And now we're continuing claims are only at 15 million. Just a month ago, they were at 20 million. Those are people that have been out for a while now, right? So good news on the employment front. Oh, additional good news. The most recent unemployment rate, which comes out monthly, first Friday of each month, that's when it comes out, right? We went down to a little over 10% from the previous month where we were in the 11s and the previous month where we hit the high at 14. So we're starting to see the trends move in our direction. Another really check the box good news. Momentum is moving in the right place. Retail spending, which is really an indication of where the economy is going next. Retail spending hit a pre-pandemic high. So when you look backwards, even to 2019, we are seeing numbers today, this past month, 1.2% in spending that we have not seen, well, in a long time. So that's good news. That means that the cash registers are ringing, even though it's via Zoom or via your phone or your pad or your laptop or whatever it is. The reality of it is we're starting to spend again, and that creates momentum in the economy and jobs feed off of that. So we'll keep a close eye on this number going forward. The stock market, which is really kind of a predictor of where the economy is going in the future. This is what's going on today. There's a lot of things that affect it, of course, but here's what's happening. You can see all the way to the left, we kind of have that almost V, but it's really like a Nike swoosh, but it's like a V. We're back to where we were before the economy was put in a coma. And keep in mind, we still do have 10% plus unemployment. We still came off the second quarter GDP at 32%. Most economists believe this quarter might actually be positive, which would be incredible. We may even be out of the recession already. So these are numbers that I think are pretty important for you to understand because what they're telling you is that we're on our way back. This patient was plugged back in, okay? We unplugged the economy, we plugged it back in, and it looks like we got a heartbeat. It looks like everything is starting to function again, but there's a long way to go. We all know it before we actually get to where we want to go, which is a full and complete recovery. Housing and housing finance, let's talk about it. So new home sales, my goodness gracious, highest since 2007 in the month of June. So you know it and I know it, that's very active in housing. Well, we lost a big number of what would have been buyers in the second quarter, and we're getting them back now. This is what it looks like year over year. So again, we put the patient in the coma, right? And look what happened. We dropped like 30% for a couple of months, month and a half, and now we climbed right back out of it, and here we go. So we're actually starting to have a pretty good year. Fannie Mae's forecast, they updated it, Doug. Knowing that it was a black swan that is coronavirus, we actually now have a forecast this year of minus 6.9 instead of plus 2.7. If you look at the second quarter, that's what really happened in terms of the decline. We were at 6.1 annual million units That's the rate that we were moving at for new for sales, total sales, new and resales. And then we went down to less than 5 in the second quarter, back up to 6 annualized in the third quarter. That's what we're feeling right now, that impact of recovery. We still won't climb all the way out and get a positive number before the year. However, the direction, like all other things right now in the economy, is very good. In fact, next year, we expect from this year's sale numbers, we expect a 3.4% incline next year. So look, if you're in our business today, and we are, okay, things are better than they were, thank God, and they're getting better by the day. Interest rates are actually lower than they forecasted because of the black swan called coronavirus. We were projecting 3.5. They're now thinking it's like 3.2 on average. You can, of course, get in the 2s with certain credit scores. We'll get to that in a few minutes. All righty. Here we go. Historical interest rates. We just talked about that, but it's important for you to know. We were, when I first got in the industry, we had gotten to a low point, like 12%. That was in 1985. Now we are at a point where we're actually, 3%, 2 3/4, 3 1/4, 3 5/8, depending upon whether you've been to Credit Essentials. We'll get to that in a minute. So here's where we are. The latest numbers are really reading right around 3%. We actually backed up a little bit last week, but I'm saying a little bit last week, right, in terms of interest rates. One of the things that's important for you to know, news you can and should use. The housing and housing finance business is being impacted. My business, not yours, impacted unless you're refinancing. Please start with Supreme. Low fixed rates have brought a financing boom in the refinance sector, which is joining the housing recovery, and that's creating a lot of traffic in our business. So this refinance business is kind of a big deal. Let's take a look at the traffic jam that we got going on right now in the mortgage industry, in mortgage companies, pipelines. See, purchase, refinance, purchase, refinance, refinance, refinance. 6 out of 10 loans in my competitors' pipelines today, in mortgage companies' pipelines today, are actually refinancing, which is good because that'll be a stimulus to the economy, but it's not good for service for you and your customers. Let's take a really close look at what does this look like. So the national average is 58% of all the loans in America today, almost 6 out of 10, right, are for the purpose of refinancing. Again, a good news story, but that also affects the service brought to you. Supreme, 78% is purchases still. Why? Because we're laser focused in our relationship on our long-term partners, which is you, to make sure that we're still open to close, and we are still open to close. Even this month, as I speak with you this morning, we could still take a loan today, close it this month. Why? Because you may need us to do that so you can get paid on time. We need to do that. The average in America, refinancing's taken 48 days. The average in America purchase is 46 days. Not very good. Time to close a loan, average 47. Again, we think that's like making some wine. I like to drink wine, but I don't like to make it. I like somebody else to make it. They make it better than I do. But Supreme, on the other hand, 22 days to close a loan. And we can go even faster than that when you need us to. Ask about it. Supreme Speed Service. All right. Let's talk about a major issue, which is emerging as a result of refinance, and that's slow appraisal processes which affect our transaction. My good friend and yours, one of our educators, he runs continuing education class for us, for you, to educate you so that you're a better professional with your customers. Scott Murphy, DS Murphy Associates, the biggest in the Southeast. I talked to Scott. Here's the data. Last year, they were averaging about 600 to 800 appraisals a month, 600 to 800 a month. This year, 1,800 to 2,000, and they cannot just add water and stir and get another appraiser. Why? Because the Dodd-Frank, the Financial Reform Act that came out of the Great Recession in 2008, requires appraisers to do about a 2-year apprentice time served. And in order to become an appraiser, they got to spend 2 years. So you cannot hire someone for an event that you didn't see coming, the black swan called coronavirus. So we don't have any more appraisers right now, but we've got a lot more transactions in lenders' pipelines. And what is that doing? It's slowing appraisers down, and that can impact buyers and sellers unless you start with Supreme. Let me talk to you about this a little bit. Here we go. You sign a contract, all the way bottom left. Step number 1, buyers, sellers, they get a contract. You need, well, before I tell you what you need to do, Then it takes a couple days for the borrower to actually make an application with the lender. It could be 2, 3, 4 days before they're so busy in life that they make that application. We've now lost 3 or 4 days against the financial contingency clock that was in the contract originally signed. Then there's something you don't know about. It's called ITP. Intent to proceed. It is a federal regulatory law. We have to get the customer to give us a ITP confirm, intent to proceed, before we can actually get their credit card and charge them for an appraisal. So that could take 1 to 2 days to get them to respond to that. And then we actually order the appraisal. So we could lose 5, 6, 7 days against your financial contingency. We're not telling you to change those. We don't want you to. But then we order the appraisal, and then it gets in traffic with all of those other cars. 6 out of 10 of them are refinances. That's not good because it could slow down your process. So what can we do? Well, what Supreme Lending is doing to ensure that we are still open to close in 8 days, if necessary. We can't close in less than 8 days. The federal government won't let us. We're doing 3 things. We're educating you today, news you can use, to help your buyers and sellers understand the condition, the traffic jam. Then we're waiving the ITP. We're not waiting for them. We're not waiting for ITPs. We're just order the appraisal. We're taking a financial risk. We're just going to order the appraisal. It'll save us 1 to 2 days. And then finally, what we're doing is we're taking our purchase transactions, and we're not saying they're more, well, those people are not more important. We're for everybody, than refinance. But those refinance transactions, they're already living in the home. So we got to get the contracts out there that our buyers and sellers, we got to get those to happen immediately. So we're putting an additional fee. We are on the tip of that spear so that our appraisers will select and prioritize the purchases versus refinances. And I'll tell you what, if my neighbor was refinancing today and my other neighbor was buying to move in, I think I could convince both of them that this is a good idea to take good care of those that have contracts that need to get in on a certain time, and ask our other neighbor, just wait a minute or two for their appraisal. Okay, what can you do, news you can use, and now how to use it to help your sellers and your buyers understand how they can get the industry's best customer experience? Because everybody wants that. Everybody wants it. You do, and your buyers and your sellers want it. Well, here's what you should do. When you write your financial contingencies into the contract, you should make sure they don't expire on a weekend, like a Saturday or Sunday. Why is that? Because they really expire to the appraiser then on a Friday, so they have even fewer days in a time where they need no fewer days. They need more days, right? So make sure they expire on Monday. Do it on Monday. Second, encourage your buyers to make application with us as soon as possible. Like the contract gets signed today, get the application filed, and then finally respond, if you're the listing agent, to the appraisal's call so that you can let them in ASAP, because if you miss them, they put somebody else in the car and move on to another transaction. So if you're the buyer's agent, call the listing agent now that you have news you can use and tell them what we're telling you so that the listing agent doesn't miss the call, because historically if they missed a call, it's no big deal because traffic wasn't so jammed. We now have a traffic jam. Can't afford to miss the call. All right, that's what you should do. Start with Supreme. All right, here we go. LLPAs, we've been talking about these, loan level price adjustment for various issues. Let's remind you that this is a reality of what your customers face every single day, and we have a solution to help serve your customers in a premium way. Let's talk about that if we can, okay? Let's move on to the Smiths. They buy a home, put down 25%, $450,000 deal, right? They are single family, 740 credit score. They get 2 and 7/8 today. Pretty good, right? $1,400 payment. Look how happy they are. Smith family, they started with Supreme. Then the Jones family, they move in right next door. They can't have a barbecue today for obvious reasons. Someday, hopefully they'll have a barbecue again. They do the same deal, but they don't put down 25%. They only put down 10%. And their credit score is not 740, it's 660. And so they don't get 2.9%. They get 3.5% and an $1,800 payment. That's right next door, $400 more. No wonder they're not as happy. And when they get to meet the Smiths at a barbecue, and they find out that they got 3.5 versus 2.9, you know what they're going to think? Mortgage company ripped me off. Unless they know that there's a pathway to do better. and they could do better. And that's what we do here. We educate, right? The Jones family, they went to Credit Essentials because they started with Supreme. That's why you should start with Supreme. Send your customers, the Jones, to us, 10% down. Okay, same transaction. But their credit score moved from 660 to 714. Their rate went from 3.5 to 3 1/8, and now they're paying $1,734. Are they paying more than the Smiths? Yes, but that's because they're putting only 10% down, and their credit score is still below their neighbors. But now they know why. Guess what? Now they know why, and they value your support. Start with Supreme so that they can actually improve their credit score before they get under contract. And guess what happens then? They're going to be your raving fans. Doesn't that make sense? That's inspiring and it's also educating, and it's also service. Credit Essentials. You can offer, it's free, 30-minute program on Wednesday night at 6 o'clock, Saturday mornings at 10 o'clock, so that Lisa Myers, the Credit Whisperer, on behalf of Supreme, can help your borrowers understand, your buyers understand exactly what they need to do to improve their credit score. And guess what? 507 customers in the last 3 months since we've had the program up and running since COVID took place. We were concerned about credit, the impact of unemployment, et cetera, et cetera, et cetera. We wanted to position a resource, educational resource, that would ultimately bring the best service. And guess what? We're seeing an average 54 points increase, an average on every customer that comes in. So your customers can save an awful lot of money if they start with Supreme. So start with Supreme and get your customers to start with Supreme. This educational tool, Credit Essentials, is just another tool we put in our toolbox to support you. Oh, by the way, ask about the Supreme Speed service. That's when you can get our racing car and go really fast. When your transaction requires you to go really fast, start with Supreme, because we drive really fast. We can go in 8 days, and we've kept our traffic clear of a lot of refinances so we can continue to drive on the Autobahn really fast, no speed limit. All right. Also ask about the Supreme Rescue Service. If you have a loan that's stuck someplace else, they're making wine with it, okay, really, like making wine with it, and you're concerned about whether or not you'll ever get to drink the wine, chat with us, because we will take a very quick look with our senior, and I mean senior people. We get right to the top with our top credit risk people, and we look how we can say yes, not no. We want to say yes. We try to find a way. All right, customer satisfaction. This is why you should start with Supreme. 98.7%, almost 99% of our customers, when they leave, they're really, really happy, which means they're going to refer you again, and then they're going to bring their friends and family back to you and to us if you start with Supreme. And then close on time, fund on time, so you can get paid on time. Can I get an amen, just one? Thank you, right? Thank you. 99.5% of the time, that's what we do, close on time and fund on time. And finally, and we've talked about the Supreme Speed Service, we can go really fast. We like to drive really fast, under control, but really fast. I'm going to finish today by reminding all of us, because at every single exchange that we have, whether it's at home with our family, whether it's with our friends, whether it's with our neighbors, whether it's with strangers, whether it's with our customers, whether it's with our colleagues, okay? We're not going to agree with everyone on everything, but if we're at our best, we'll be for everyone. We will. We'll still be for everyone. And we'll learn that we're not going to be for everything, and that's okay. But we need to be still for everyone. Get on a Supreme bus, because we're going to the destination that we all want to go to, and that is best. Look forward to seeing you next week.